Most audit students learn a list of procedures just well enough to pass an exam, but knowing the list and knowing how to apply it in practice are two completely different things. In this video, we'll go beyond memorization and show you how audit procedures and evidence actually work in real-world engagements. This builds on my other video covering the full audit process. I'll link it so you can see exactly where today's topic fits.
So here's what we're going to do. We're going to break down the entire system of audit procedures and audit evidence from the ground up. By the end, you'll understand how to look at any account balance or transaction and immediately know what category of procedure to use, what direction to test in, and what kind of evidence you actually need. Let's start with the basics. Audit evidence is every piece of information the auditor uses to reach a conclusion. That's it. But every piece of information does a lot of heavy lifting. We're talking about the general ledger, journals, reconciliations, bank statements, contracts, even a conversation you had with the warehouse manager about that pile of rusting inventory. All of it counts. The question is never, is this evidence? The question is always, is this evidence good enough? And that brings us to the two concepts that will follow you through your entire auditing career: sufficiency and appropriateness. Sufficiency is about quantity. Did you get enough? Appropriateness is about quality. Is it relevant to what you're testing, and is it reliable? These two work together like a seesaw. If your evidence is of exceptionally high quality, like direct external vendor statements confirming your major accounts payable, you might need less detailed item-by-item testing. But if your evidence is weaker, like an internally generated aged receivables report from a company with terrible controls, you're going to need a much larger sample size, and you'll need to corroborate it with independent testing. This brings us to the reliability hierarchy from ISA 500, which is worth burning into your memory. Evidence from independent external sources is more reliable than internal evidence. Internal evidence created under strong internal controls is significantly more reliable than evidence created under weak controls. Evidence obtained directly by the auditor, like physically watching an inventory count, beats secondhand evidence. Written documentary evidence and original documents beat verbal statements and photocopies. Evidence from multiple independent sources pointing in the same direction beats a single source every time. Think about it like building a court case. One witness is a start, but 5 independent witnesses all saying the same thing gives you proof. Before you pick any audit procedure, you have to answer the primary decision gate under ISA 330. Are you testing controls, or are you performing substantive testing? Tests of controls evaluate whether the client's internal control system effectively prevents or detects material misstatements. Substantive procedures test the actual dollar amounts in the financial statements. Substantive procedures split into 2 types: substantive analytical procedures, looking at big-picture relationships, and tests of details, examining individual invoices, balances, and calculations. ISA 500 officially categorizes all audit procedures into 7 standard types.
So here's a memory trick. Think CORI, like air corridor.
Each letter maps to a procedure. A for analytical procedures, I for inquiry, R for recalculation, C for confirmation, O for observation, R for reperformance, and I for inspection, which covers both records and tangible assets. Let's fly through that corridor. We'll start at the wide end. Analytical procedures. This is where you step back and look at the big picture. You analyze relationships and trends. Revenue grew 30%, but the industry only grew 5%? That's a red flag. Gross margin jumped from 40% to 55% with no change in pricing or product mix. Something needs explaining. Analytical procedures range from simple trend analysis all the way up to regression models and Benford's law analysis. ISA requires them at 2 stages, during risk assessment at the start and during the overall review at the end. They're mandatory, and they're often what tells you where to aim the rest of your procedures. Next, we have inquiry. You ask people questions. You ask management about their accounting estimates. You ask the warehouse manager about slow-moving stock. You ask the IT department about system access controls. Inquiry is everywhere in an audit. But here's the golden rule. Inquiry alone is never enough. Never. You can't just ask management, are all your revenues real? And write down yes in your working papers. You need to corroborate, always. R for recalculation. You check the math. Depreciation charges, tax provisions, inventory valuations, foreign currency translations. You grab a calculator, or better yet, you use audit software, and you verify that the numbers add up. Simple concept, but it catches more errors than you'd think. Moving on to the C, confirmation, specifically external confirmation. This is one of the most powerful tools in the auditor's bag. You go directly to a third party and ask them to confirm information. Banks confirm account balances and loans. Customers confirm how much they owe your client. Lawyers confirm pending lawsuits. There are 2 types of confirmation. Positive confirmations ask the third party to respond whether they agree or disagree. Negative confirmations only ask them to respond if they disagree. But within positive confirmations, there's a stronger version, the blank confirmation. Instead of showing a balance and asking, is this right? You give the third party no numbers at all. You simply say, tell us what you think the balance is. That's more reliable because the respondent can't just glance at a number and lazily say, yeah, that looks right. They have to actually go check their own records. The trade-off? Fewer people bother to respond. Next up, observation. You watch someone do something in real time. You observe the client's staff counting inventory. You watch the mailroom opening process to check whether cash receipts are being handled properly. But here's the catch. Observation is limited to that exact moment. People behave differently when they know someone's watching. So observation gives you a snapshot, not a movie. You'll almost always need to pair it with something else. That something else could be reperformance. This goes beyond just checking math. You redo the entire procedure or control from scratch. The client prepared a bank reconciliation? You prepare your own independent version and compare. The client aged their receivables? You re-age them yourself. Reperformance is especially powerful for testing internal controls, because you're not just asking if the control worked, you're proving it. Lastly, inspection, which breaks down into two distinct practical actions: inspection of records and inspection of tangible assets. For inspection of records or documents, we're examining internal or external records in paper or electronic form: contracts, invoices, bank statements, and board minutes. Reliability depends on document origin and internal control strength. For inspection of tangible assets, we're physically inspecting physical assets like machinery, equipment, or inventory. Physical inspection provides strong evidence of existence. But remember, seeing a building proves it exists. It does not prove who holds the legal title deed or whether it's impairment-free. Now let's talk about something that separates good auditors from great ones: direction of testing. The logic is beautiful in its simplicity. If you're worried something is overstated, something is recorded that shouldn't be, you start from the accounting records and track backwards to the supporting documents. This is called vouching. You grab a recorded sale and try to find the invoice, the delivery note, the customer order. If you can't find them, that sale might be fiction. If you're worried something is understated, something exists that wasn't recorded, you go the other way. You start from the source documents and trace forward into the records. This is called tracing. You grab a stack of goods dispatch notes and check whether every single one has a matching sales invoice in the journal. If some don't, you've got unrecorded revenue. Here's the pattern. Companies want to look richer, so they overstate assets and revenue. That means you test existence for assets and occurrence for revenue. Companies also want to hide what they owe and what they've spent, so they understate liabilities and expenses. That means you test completeness for both. Every overstatement risk, you vouch. Every understatement risk, you trace. Every audit procedure you perform ties directly to a management assertion. Assertions are the explicit or implicit claims management makes when preparing financial statements, and they map directly to specific financial statement components. For transactions, you're testing occurrence, completeness, accuracy, cutoff, and classification. For balances, you're testing existence, rights and obligations, completeness, and valuation. For disclosures, you're testing occurrence, completeness, classification, and understandability, and accuracy.
The art of auditing is mapping the right procedure to the right assertion for the right account. Testing the existence of receivables? Send confirmations to customers.
Testing the completeness of payables? Do a payables search, go look at payments made after year-end, and check for unmatched goods, received notes. Testing the valuation of inventory? Vouch costs to purchase invoices and compare carrying amounts to net realizable value. Everything you do, every procedure you perform, every piece of evidence you gather, it all needs to be documented. ISA 230 requires that your working papers are detailed enough that an experienced auditor who has never seen this engagement before could pick up your file, read it, and understand exactly what you did, what you found, and what you concluded. That's a high bar, and it's intentional. Your working papers are the proof that you did your job. If something goes wrong down the road, if the client turns out to be committing fraud, your documentation is your defense. Here's how the whole system connects. You identify the assertion, you assess the risk, higher risk, more evidence, more reliable sources. You choose your procedure, gather the evidence, and evaluate. Is this sufficient and appropriate? If no, you keep going. If yes, you document and move on. That cycle is the core of every audit engagement. If you've watched our video on the full audit process, you've seen where this fits. It's the engine behind the fieldwork phase. Every ISA, every tool, every working paper exists to answer one question. Can I trust these financial statements? And if the answer isn't a clear yes, you keep digging until it is.
If you want to go deeper on any of these areas, drop a comment and I'll see you in the next one.